Stop whatever you're doing. What you're about to learn is not speculation. It is a warning based on an internal document from one of the world's largest investment banks. An internal memo from Morgan Stanley's commodity trading desk was sent to their institutional clients. The directive is simple and clear. Exit all silver positions before month end. Not hedge, not reduce, exit. This is not a recommendation. This is an evacuation order. The implications of this directive extend far beyond Wall Street. It could reshape the silver and broader precious metals market in the weeks to come. Morgan Stanley manages trillions in client assets. When an institution of this size instructs its clients to exit positions, it is not routine risk management. It is a strategic move based on data, analysis, and market intelligence unavailable to the general public. This memo highlights extraordinary volatility and structural changes in the silver derivatives market. The bank is advising clients to close long and short positions across COMEX silver futures, options, and over-the-counter silver swaps. The recommendation applies to all position sizes and all expiration dates. All positions should be closed no later than month end. History demonstrates the consequences of ignoring institutional warnings. In March 1980, the Hunt brothers attempted to corner the silver market. They accumulated massive physical positions, driving prices from $6 to $50 an ounce. Banks that were short silver initially ignored the risks. Eventually, when market rules were changed, positions were forcibly liquidated. Some institutions survived, but many retail and small investors suffered heavy losses. In 2008, during the global financial crisis, interbank lending froze. Institutions realized they had exposure to counterparties who could not meet obligations. Banks that exited or reduced exposure early survived. Those that waited or underestimated risk faced failure or bailout. In 2022, the London Metal Exchange faced a massive short squeeze in nickel. A Chinese company had built a huge short position, which caused prices to spike. The exchange halted trading and canceled trades to prevent default. This event demonstrates how feedback loops and structural vulnerabilities in commodity markets can lead to rapid dislocations. Morgan Stanley's memo describes 3 converging crises in the silver market. The first is the inventory crisis. COMEX registered silver inventory has fallen below 32 million ounces, the lowest in more than a decade. 6 weeks ago, the inventory was 41 million ounces. This is a loss of 9 million ounces in just 6 weeks, or 1.5 million ounces per week. At this rate, the registered inventory could reach 0 in roughly 8 weeks. The eligible category, totaling over 230 million ounces, cannot mitigate this risk. Most eligible metal belongs to private holders, storing it in COMEX vaults. They have no obligation to sell and are unlikely to release it, while premiums in Asia and Europe remain higher than the COMEX spot price. The second crisis is delivery requests. Typically, only a small fraction of futures contracts require physical delivery. However, recent data shows 9% of open interest in the last delivery month stood for physical delivery. Preliminary estimates for the upcoming month suggest 12 to 15% may stand for delivery. COMEX has only 32 million ounces in registered inventory. This creates a mismatch between demand and supply, a structural vulnerability that threatens liquidity. The third crisis is counterparty risk. The over-the-counter silver derivatives market is vast, with an estimated 5 to 10 billion ounces of notional exposure. Most positions are hedged, but some institutions that are short are showing signs of stress. Morgan Stanley can observe these risks through interbank activity and repo markets. Liquidity squeezes can propagate quickly. If one counterparty fails, the interconnected nature of the banking system can trigger cascading defaults. The 3 crises, inventory depletion, rising delivery demand, and counterparty risk, are not independent. They reinforce each other, creating a self-accelerating feedback loop, which Morgan Stanley refers to as the doom loop. As registered silver declines, market participants begin to worry. They anticipate that delivery may become impossible. This fear drives an increase in delivery requests. As delivery requests rise, the registered inventory drops further. This accelerates panic and the cycle continues. Short sellers, institutions that have sold futures without holding physical silver, begin to cover their positions. Short covering requires purchasing physical metal. As they buy from COMEX warehouses, inventory falls further. This is the second loop. Inventory decline triggers short covering, which accelerates inventory decline. At the same time, premiums for physical silver spike in global markets. Physical silver can trade $15, $20, even $30 above the COMEX spot price. Arbitrage opportunities exist in theory, but if COMEX cannot deliver physical metal, arbitrage is impossible. The result? Paper silver becomes unreliable, further driving demand for physical silver. 3 feedback loops, falling inventory, delivery requests, and rising premiums, interact simultaneously. This amplifies volatility and pushes the system toward collapse. Morgan Stanley's memo instructs clients to prioritize orderly liquidation over price optimization. This means institutions are willing to accept losses to exit positions safely. The bank itself will reduce proprietary exposure to zero and will not accept new silver business until further notice. This is unusual. Banks exist to make money. Turning away revenue indicates that the risk of holding silver positions outweighs potential profit. Institutional exits are strategic. If banks exit simultaneously without coordination, the market could experience disorderly liquidation. By providing a month-end deadline, Morgan Stanley is controlling the pace of exits. They are managing a retreat, not acting out of altruism. The memo also protects the bank from legal liability. If clients lose money and the bank had not warned them, lawsuits and reputational damage would follow. The divergence between paper silver and physical silver is a critical risk. Paper silver includes futures contracts, ETFs, and unallocated accounts. These instruments depend on trust in the COMEX system and counterparties. Physical silver, held as bars or coins, exists independently of the market infrastructure. When institutional exits occur, paper silver may experience price swings unrelated to fundamentals. Liquidation of long positions pushes prices down. Short covering pushes prices up. Violent intraday swings of $5, $10, or even $15 are possible. Retail investors relying on paper silver may face margin calls, forced sales, or even settlement disruptions. Physical silver will retain value and may trade at premiums far above the current COMEX spot price. Investors should monitor COMEX registered inventory daily. A decline below 25 million ounces signals imminent stress. Tracking institutional actions is also essential. News of other banks reducing silver exposure confirms that the exodus is accelerating. Month-end is not arbitrary. Banks must mark positions for regulatory reporting, capital ratios, and leverage calculations. Holding silver positions at that time could show massive losses, regulatory scrutiny, and reduced borrowing capacity. Exiting before month-end ensures institutions and their clients are protected. For retail and smaller investors, this creates a narrow window to act safely. If you hold paper silver, you must plan an exit or convert to physical metal before month-end. Do not wait for prices to confirm what is already unfolding. Every day that passes narrows the window of opportunity. Physical silver holders should maintain their positions. Short-term price fluctuations in paper silver will be misleading. These fluctuations reflect forced liquidation, not changes in supply or demand fundamentals. Investors acquiring additional physical silver must act early, expect premiums over spot to rise. Delivery times may be extended due to demand pressure. Obtaining physical metal now is preferable to waiting until institutional exits are complete. When the market stress peaks, physical silver will be the only reliable store of value. History demonstrates that ignoring institutional warnings can be catastrophic. During the Hunt Brothers Silver Corner in 1980, many retail investors and small institutions suffered devastating losses. The lesson is not that shorts always win. It is that when stress reaches extreme levels, market authorities may change the rules to protect the system. In 2008, institutions that exited risky positions early survived the financial crisis. Those that remained exposed faced liquidity crises, defaults, or bailouts. In 2022, the LME nickel short squeeze revealed how sudden structural stress can lead to rapid price distortions. Morgan Stanley's institutional memory incorporates all of these historical lessons. Their internal models now signal a combination of inventory, delivery, and counterparty stress in silver. Their decision to exit is a calculated, evidence-based response. Once institutional exits accelerate, liquidity in the paper silver market will collapse. Bid-ask spreads may widen dramatically. Price discovery will be unreliable. Retail investors may experience margin calls, forced sales, or settlement failures. Physical silver premiums will spike. The divergence between paper and physical silver may reach unprecedented levels. The broader precious metals market could be reshaped. Investors who recognize these dynamics early will have an advantage. Those who wait for confirmation may face losses or an inability to acquire physical metal. The market will appear chaotic to the public. Media coverage will lag institutional awareness by weeks. By the time mainstream reports highlight the crisis, the institutional exit will be nearly complete. Morgan Stanley's memo is a documented fact. The timeline is real. The countdown has begun. Month-end is the critical deadline. Investors must act decisively, monitor inventory and institutional actions, and prioritize physical holdings. The market will be volatile, uncertain, and unpredictable in the weeks ahead. Those prepared with accurate information and strategy will be positioned to navigate the upheaval. This is not speculation. This is intelligence derived from one of the world's largest investment banks. The choice is yours. Act early or risk being caught unprepared.